Good afternoon. We start with the U.S. Federal Reserve holding its key interest rate steady for the second consecutive time as inflation slows. Yet it has not taken a rate cut either, saying the economy remains strong. Now that keeps the wide rate gap between South Korea and the United States also unchanged. Ahn Sung-jin reports.
The U.S. Federal Reserve has decided to maintain interest rates in the 5.25% to 5.5% range. This was the second consecutive meeting after September where the FOMC held rates steady at a 22-year high. The decision is mostly attributed to a slowdown in inflation as the consumer price index recorded an on-year decrease, while the U.S. economy has been growing at a constant pace over the past month, potentially increasing the growth rate to the 2% range. An increase in the government bond rates also reduced the need for additional interest rate hikes by the Fed, as borrowing costs for households and businesses rose.
Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations.
The Fed's second straight pause follows a series of rate hikes over the previous year and a half, including 4 in 2023, as the committee fought to tame high inflation. Though inflation has cooled since last summer when prices peaked at a high unseen in nearly 4 decades, inflation is still lingering above the Fed's target of 2% per year, hinting that a future hike may be needed.
But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. We'll be looking at all those things as we make a decision in December. We haven't made that decision.
The latest decision also means that the rate gap between South Korea and the U.S. will remain in the 1.75 to 2 percentage points range, as the Bank of Korea has kept its benchmark rate at 3.5% for nearly a year. This rate difference prompts concerns over the South Korean won-U.S. dollar exchange rate, as inflation remains high in South Korea due to an increase in the price of petroleum and agricultural products.
As the US froze its interest rates, the burden caused by the difference has been somewhat reduced. But even so, the gap is not small. So if this extends, there will be a lot of risks like capital outflow, with the US becoming more foreign investment friendly.
He also added that the interest rate gap would not last forever, which is why it is necessary to also watch for increased household debt ahead of the upcoming central bank meeting. As the U.S. has maintained its interest rate, there is a high chance that the Bank of Korea will also hold its rate. However, as the responses for increased inflation and higher debt differ, this may change how the benchmark rates for the two countries will unfold. Ahn Sung-jin, Arirang News.